Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to talk a little bit about information on Twitter, uh, mostly commodity related stuff, some other investment related stuff on Twitter. If you want to follow me on Twitter, my name on Twitter is at finding_finance. You can follow me on there, and we'll walk through a couple of shared tweets that I've got just to kind of go over some things. This is the 30 years of U.S. Consumer Price Index. They just released the numbers, 9.1%. And, all the thing that's kind of weird here is we're getting higher rates of inflation. We've got increasing interest rates, et cetera, et cetera, et cetera. You'd think this would be more, you think it would be more bullish for oil and natural gas and all these other things, but we're still getting a pullback. So perhaps further rate hikes are what people are afraid of. Not exactly sure. I think I saw some dumping of futures contracts in the precious metals when this was released. You could see a kind of a spike down, but that's where we're at. That's what's going down with the U.S. Consumer Price Index. It's moving on higher, and it's far higher than the past 30 years, all the way back into the early 90s. Zero Hedge writes, if the Fed pivots early, commodities will go suborbital. And I think the Fed is in a difficult position. I think they will continue to raise rates. They're going to sacrifice bonds in the stock market, and that money's going to rotate like no other. And I don't know how they're going to control all of this. I'm not exactly sure how they're going to control the rotation of money and keep that money out of commodities. Because if it goes into commodities, your CPI number goes higher and higher and higher. And they only have so much in the Strategic Petroleum Reserve. And once we link up with natural gas to the our LNG facilities that are going to be purchased and built in the mid-2020s, we're going to get a stronger and stronger link to the international prices, which could increase natural gas prices for a while. Cuppy wrote, like clockwork and the turn gathers strength off to Switzerland. Gonna let these names grind all summer. The pause in Project Zimbabwe is officially over. Jay Powell gonna do this thing and then dove out. So he writes, we just hit peak inflation fear for a few quarters. Inflation assets have been nuked in the past 6 weeks. We are past the big bad number. These assets are just flip green. Think this is the turn on the pullback I'm adding here in size. That's what that's his opinion. I do think that we see short-term buying pressure here, which is a good thing. But we have to see that buying pressure sustained. The way that I handle this is I just cost average in to where I think we're at either support levels or where I see buying pressure, and I sprinkle and sprinkle and sprinkle. Basically cost averaging in, trying to get the best price possible where I see strength or support lines. Coming on down, Josh Young, it says, oil price decline may be short-lived, according to the Chevron CEO. He says the market remains tight, the physical market. My take, the oil market is tight, but it is hard to accurately predict the short term. Yeah, that's basically what my entire things about is. I don't play the short term. It is too hard to predict. Even doing short-term trading or chart pattern analysis, it is a lower probability of being right. I agree with this take. I did a quick little we'll call it poll here. I said, what would you buy? Physical platinum, physical silver, oil, natural gas equities, and uranium equities. I've got a lot of uranium followers, so it's natural for uranium to be one of the largest getting votes. Oil and natural gas equities, I think, look attractive. I think uranium looks attractive. I think physical silver and physical platinum all look attractive to me. That is my problem. When I get money, everything looks attractive to me, So I think all those assets look really good. That's why I put it up there. Now, Graham Stephen, he writes, before buying a home, be aware that mortgage rates are predicted to reach 8 to 10% in 2023 and 2024. If that's the case, that means that interest rates are going to continue higher, that we don't have a recession in front of us. Maybe this recession fear is brought about to suppress the price of certain things for a while. Maybe it's all fabricated. I don't know. But I don't know where he's getting this information either, but that's a pretty high rate. What that means is that they see strength in the housing market and they also see strength in inflation. But that's crazy to get that high. I wouldn't even guess that high. Even at the beginning of the market, I thought they would come in, do QE, and hold it lower at a level more like 5% is what kind of I was thinking. 4.5%, 5.5%, somewhere in that range. Patrick posts a pretty cool chart here. I like it. It says the SPX adjusted for producer price index. So it's the ratio SPX divided by the PPI. Whenever this breaks down to the downside, we see these periods where it breaks to the downside. 69 was the bull market in commodities that came. 2022 was the bull market in commodities which came. In 2002, it was when commodities really broke out. I think we're on the precipice of a big commodities boom. Obviously, I talk about it all the time, but this is a pretty cool looking chart. One thing that's kind of weird here, the close below the 7-year moving average once the trend line is broken confirms the paradigm shift. That is the cycle. This is the real estate cycle that he's basically charting out here. And that's why it's in this rhythm. It's the real estate cycle. Well, at least that's my opinion. Coming on down, bullish oil perspective from RB Advisors and Cornerstone Oil. I agree, global demand has been quite strong considering, and when China eventually fully opens, it says, don't be too quick to write commodities off. Global pound or hashtag oil demand has been strong despite China's lockdown. Demand is likely to strengthen as they reopen. So global demand is over 100 million barrels roughly, and we could be seeing some increased demand for oil with some reopenings. Thinking about what might have happened if Freeport LNG hadn't had an explosion. We're up to 676. We're heading higher today, 9.62%. And if the Freeport LNG, which is 20% of liquefied natural gas shipping terminal, LNG terminal, if that was still up, we'd be in a really tight market with natural gas. Really, really tight. Texas power demand to exceed planned supply mid-afternoon, July 13th. Tavi posted a really, not even this curve. I'll go one below it, but he posted some pretty good information here. Every time the yield curve inverted, the Fed was forced to end its tightening cycle. One of the things that he shows here. This is the cool one I like. It says, in case you think the selling pressure in oil is solely driven by recession fears, the U.S. government just sold another 27 million barrels of oil just in the last month. At this pace, the Strategic Petroleum Reserve will be zero in 18 months. Completely unsustainable and will end badly. The question that I have is, they're ramping the Strategic Petroleum Reserve releases up. What happens when this goes back to zero? Is this a slingshot in the making where if we get into a tight scenario and they basically run out of Strategic Petroleum Reserve and they have to cut this off, that we could see a pretty big price spike in oil? It's a possibility. That's what I'm going to say. Eric Nuttall says, eventually energy stocks will diverge from the insane day-to-day WTI volatility once a floor for the oil price is found. With stocks discounting 50-ish WTI and generating record free cash flow, does it really matter if oil bobs around the $100 mark or even heads a bit lower short term? No, it doesn't matter. I like this quote, great investing requires a lot of delayed gratification. Charlie Munger. Kyle Bass says oil will go back to 150 to 200. Sounds reasonable to me. I actually agree with that as well. It's probably may even go higher depending on how they stop the Strategic Petroleum Reserve and how tight the market is at that time. He's got oil, another look at OPEC's oil production versus quotas. Big gap and potential peak well below market expectations. The OPEC quota is the one in the dark or the lighter color, and then the dark line's the production, 7%. gap that is opening up. We've got John Hinster here, URA. We are barely breaking out. Uranium is at the second inning, in my humble opinion. And that's also what I think. I think we are very early in this mix. I don't know how I don't know how I could live with myself if I sold uranium and missed this big move. So what I'm doing is obviously implementing the strategy of a buy and hold strategy. We've got basically a consolidation correction going on still, and we're at this nice support base level. I think the support line is probably pretty strong here, and John's expecting a move higher. I would agree with that, and I like uranium quite a bit here. And I've gone over these other ones, so that's what I've got for today, guys. Just wanted to touch on some Twitter information, see what I'm seeing out there. And if you guys are interested in learning more about how I'm playing this market, definitely subscribe to the Platinum membership below. You can see what I'm buying, what I'm looking at. I'm looking at a lot of natural gas, oil. I'm looking at some uranium companies, and I'm just waiting for strength. That's what I'm waiting for. I did dab a little bit in. I was getting a little bit. I panic buy. That's what I say. I don't panic sell. I don't sell in panic. I panic. When others panic, I panic buy. So when I see things in sentiment very low, there's a very low sentiment right now. In commodities, very low sentiment. In oil, everybody thinks it's going to be going to 60 or some other thing. And that's when I get in there. I have to buy a little bit. I did dip my toes in a couple of things. If you want to know what I bought, it's on, it's in the Platinum membership in the description link below. If you guys want to know what I'm buying. I think I'm buying some of the highest leveraged companies that are out there in natural gas. I think the opportunities in natural gas. I think uranium's looking good too. Everything looks good to me right now. I want to buy it all. I really do. And I'll cost average in, guys. I don't buy everything in one shot. I just sprinkle. And I try to get the best I can. If we get pullbacks over 30%, I start sprinkling a little bit. I become a sprinkler. I'm just sprinkle the entire portfolio. And that's what I do. And let's say you get like a large decline. Let's say it's a 50% decline. If I start sprinkling in at minus 30, I get all of that entire bottom if I sprinkle in the entire way. That's what I do. I cost average in over time, and I get the entire bottom. Now, I don't think we're going to go down and stay down for a very long time. I think we're going to go down, or maybe we start to rebound a little bit here. We'll find out over the next couple of weeks. And on pullbacks where I see a pullback and then I see strength coming back up, and as long as we're at a support line, you know what I'm going to do? I'm going to do some sprinkling there. Sprinkle a little bit in. It's just what I do. But that's all I've got for today, guys. Hopefully you enjoyed the content. Appreciate you guys listening. We'll catch you next time. This is Finding Value.